So where do we see the market at today? I think that these are all of the reasons why and have been the reasons why through the last decade plus running, we have seen year over year rate increases on the auto liability side of things. And they're challenging items, and some have come into the world, a decade ago with a lot of, I think, promises or hope that it might help to stymie the losses and help folks with the claims experience. And by that I mean telematics. And what we have found as well, they have helped to some, they have hurt others, depending upon how folks have deployed the use of the telematics and the subsequent data that they're given by the telematics systems and what they do with that data. So, to kind of dial into each of these, right, as we see the marketplace now, probably the number one and two things, are both inflation of claims, but also the push on litigation, right? And they kind of go hand in hand, which I don't think is a surprise to anybody, right? We're seeing far more litigation than ever before, far larger limits, or I would say demands for settlements and values attached to claims, partially because of the inflation and cost of everything else, and partially because, look, plaintiffs' attorneys are winning. And anytime that starts to go, everybody sits up, takes notice, and they're also going to go for it. Add to that our friends in the creative, I'll call it the creative funding space, where they see an opportunity to fund litigation and see a 5, 10x return on that investment when they can push for a giant claim settlement or a nuclear verdict. So you're seeing those kind of come into play, and they have been, but they'll continue, I would say, into the future here, unfortunately, until we see some tort reform and we see some things start to change in a lot of the key states and key areas where the litigation and the claims are occurring the most.
Yeah, I mean, I would just add too, Brian, in terms of that, I think, we've been in this cycle, as you mentioned, for a long period of time. I mean, we're at the 14th consecutive year now where auto insurers have posted 100% plus loss ratio. So it's no secret, the market is hard, continues to firm, and capacity is limited. But I think the buzzword that's been in play for so long is nuclear verdicts. You touched upon that with the litigation funding. And I think people are just tired of hearing that word, quite honestly. When you kind of peel back the onion further, I think the bigger issue and the bigger buzzword that gains some momentum here is settlement creep, right? I mean, when you think about it, there's thousands of claims that happen every day that settle for way more than what they should, right? And so you don't know in today's environment if you have a rear end collision that if it's going to settle for $10,000, if it's going to settle for $100,000. So that actuarial data that's being used by underwriters to compute rates, and they're looking back 3 years ago in terms of where they should be pricing their rates for today is being based on data where those reserves might not be satisfactory, might not be up to par for the current claims environment. And so that's why you see what you see in the marketplace, it's where the insurance carriers are constantly playing catch up, in terms of their pricing. And to the point where if they can't catch up fast enough, they exit the space. And that's what's contributing to, the pricing concerns and the limited availability within the market.
Yeah, I think on the technology side of things, as we kind of alluded to with telematics, right? That's a double-edged sword so many times. The number of times we see the telematics data that supports that our insured was doing the right thing at the time of the loss. Unfortunately, it can be equally as damaging or more damaging when we know that there was telematics data there that alerted a customer that the driver maybe had a history of questionable choices behind the wheel, say with their speed, with their braking, with their lane changing, right? And then ultimately that becomes the driver that gets into the accident or the large loss. And here we are with that data coming into the court in the case and helping to push the plaintiff's demands higher and higher. So we look at, and the other part of technology, I think that's driven costs up, just the tech on the vehicles, right? You can't You can't bump a vehicle anymore of any size and not have thousands of dollars of physical damage to it based on the technology that are on the vehicles, let alone, some sort of actual collision. So that has pushed, I think, the physical damage cost, the comp and collision rates up, not as quickly as the liability has, but boy, those have also risen fairly quickly. And then you get into situations like we all experienced during COVID where parts are scarce, production is low, and it just further inflates the cost of both the labor and the parts to fix those things, which drive claims costs up too.
And I think ultimately in this industry, you constantly hear the old, continued beating of the drum of driver inexperience, driver shortage. I mean, let's face it, the labor pool is aging out and is becoming even more of an issue, right? Flow in the fact that, in some areas of the market, some verticals, they rely on pure 1099 labor, right? Which, oftentimes can be difficult to control from a safety and loss control perspective for fear of misclassification concerns, right? And obviously we have some thoughts on that ourselves, but the point is that the driver side of the equation can also contribute to what we're seeing in the market also.
We can go on to the next slide. Thanks. So, as you might imagine by listening to the whole spiel on the last slide, the forecast is not exactly the rosiest, So, Brian Ice, where do you see the market going in the coming year?
Yeah, I mean, it's going to continue to rise. I mean, I've seen a little bit of stabilization, better accounts. We can push back with some of the underwriters and help have a lesser increase, but for the most part, we're still seeing increases. So again, that's why you've got to really look at the total cost of risk and analyze what makes sense. If you're not having a lot of claims from a frequency standpoint, it may make more sense to take out a little bit of a deductible. I mean, we're not talking about, super large deductibles, but something that might help offset some of those general increases that we're seeing, whether it's company wide, program wide. It's kind of a carte blanche approach that we're seeing the majority of carriers out there just taking. So if there's a way to help offset that by taking on a little bit of skin in the game, then I would do that. But analyze it. What makes sense based on the frequency and severity of losses that you're actually having? Investing in the technology. Cameras and telematics are becoming not optional. It's
Right.
almost a requirement. It's a prerequisite at this point. Quite frankly, the government should make that a requirement. It's just the reality of where we are today, and it does work against you at times, but the reality is better driving forces have this systems implemented and understand how to react to the data that's being provided. That's the other key element is while it spits out a lot of this great data, if you don't utilize it in correctable actions, it's worthless. So you've got to have the right, assistance in coaching your teams in order to properly deploy those data points. FA and safer scores are huge right now. CAB reports tell a lot about an operation. We were on a phone with a call with an underwriter in the excess space yesterday, and they view the CAB reports and the safer scores as more important sometimes than the loss data because it shows behavior. It shows the type of drivers that you're hiring, which is super important as well. Like what are your prerequisites for your driver hiring? I realize that there's in some cases driver shortages, but the proof is in the pudding. The better drivers seem to produce better results for a driving force. So reviewing the excess limits is important. We know that the pricing's kind of following suit in the excess space, but we're also seeing more customers of transportation companies requiring higher limits. So how do you do that? There are creative other programs out there, which we had this conversation yesterday with a new program that happens to have some less costly alternatives that can meet those needs. So certainly speak to us if you need some help on that and trying to curb some of those increases as well. Because like I said, they're following suit with the primary auto. So unfortunately, it's not roses and rainbows here, but there are ways to mitigate the ongoing increases if you do it strategically.